The Labor Department released its jobs report for the month of August this morning, and it shows that the U.S. added nearly 1.4 million jobs last month. That is down from the 1.8 million jobs added in July, but the unemployment rate also dropped to 8.4%, the first time it's dipped into single digits since the start of the pandemic. To explain what this all means for Americans and the economy, let's bring in Optimal Capital Director of Strategy, Stacy. All right, so you've taken a look at the numbers. What story do the numbers tell you?
So it's not getting worse. It's definitely getting better. I would say that we're not out of the woods completely yet. We still have a lot of uncertainty around airlines letting people go. At the end of September, we still have uncertainty in the credit markets as far as, who can pay their mortgages and who can't, or their rent. We have, a larger percentage due to the pandemic of people who have food insecurities and things like that. And so we're not out of the woods yet, but this is definitely reassuring. And we'd definitely be having a different conversation if these numbers were going in the other direction.
What areas are we seeing jobs being created?
Well, the services sector, food service upticked a little bit. Manufacturing is still upticking a little bit. Retail, importantly, upticked a little bit. And what this tells me is that employers are hiring, expecting a reopening to come. And maybe that's confidence in the vaccine. Maybe it's the fact that the COVID numbers and the severity of cases are dropping. But they're kind of, the reopening is starting to be sort of priced into that picture. It's also happening with the markets. I think it's really interesting because the NASDAQ sold off. And even though, we think of tech companies as being high growth and very speculative, et cetera, they really were the flight to safety during the pandemic because they had very strong balance sheets, meaning that they weren't likely to default. They could take on debt for low costs. And people were using technology as the stay-at-home play. So even the rotation out of tech in a big bad way almost maybe says, okay, we see a reopening on the horizon.
Okay, I want to talk about that crazy plunge on Wall Street in a second, but I just want to ask you, some economists say that the progress that we're seeing is actually a little too slow. What's your take on that?
Yeah, definitely. I mean, we're going to be hitting very soon that 26-week mark, which is where most states consider people ineligible after providing 26 weeks of unemployment benefits. So we definitely have some headwinds. The other headwinds are the fact that 62.5% of businesses are saying that if they cannot get back to somewhat normal capacity, that they're going to shutter. We have corporate bankruptcies that are going up. We have people walking away from, their restaurants with just leaving their leases and not even bothering to file bankruptcy. So we are still statistically missing some numbers from what the temporary versus what the permanent damage from the pandemic is going to be. And as those numbers get filled in, I think that we're going to find a surprise, being that the longer that we have things shut down, the longer that the pandemic goes down, you're going to have more permanent consequences. And that's still in the mix. But I think psychologically, on the other side of it, people are starting to see reopening future. COVID's not going to dominate my life forever, basically.
Okay, let us talk about Wall Street. And we've talked a number of times about the disconnect throughout this whole thing. How, as you mentioned, there are people who are going to food banks that never thought they'd go to food banks before, people who are unemployed. But then Wall Street has been having a great old time through this pandemic. Yesterday, something wacky happened, though, this massive 8-point slide in the Dow. I think you were sort of touching on it a little bit when you talked about people putting their money in tech stocks. So what happened yesterday?
Well, what's interesting is the Fed and, the federal government injected $3.5 trillion into the economy. And so that money suddenly had to go somewhere. And it always goes to asset prices before it trickles into other areas. This is the big problem from the global financial crisis, is that it took so long to have all of that money coming into circulation with the quantitative easing, which just means adding money via debt to circulation to get an uptick in wages. And so that money, when it comes into circulation, treats different echelons of the economy differently at different time periods. And it's always going to go to the top first. It's going to create an asset bubble. And then if that asset bubble kind of gets sustainable, then those companies start hiring and creating jobs, and then the wealth kind of trickles down. That's the whole ideology behind supply side economics, which is just to say, if you empower the top, you're going to have a trickle down effect. It's a very opposite of demand economics, which is more the left ideology, which is to say that people have to demand in order to get the money, applied and moving and incentivize supply chains to produce products, right? They're both true. Mm-hmm. Both of those ideologies behave differently at different times in the business cycle. And the business cycle is very simply when you go from growth to basically over levered and you have a recession, and then you lever up again, you get some growth and you go back to a recession. It's a natural thing. We're very much late cycle. We've been late cycle pretty much since Trump cut taxes at the end of 2017. And so the thing is that when you're late cycle, you start to see a divergence between, where people put their money and what part of the economy it touches. And, you compound that with the pandemic, and the wealth gap, which is widened arguably over every business cycle, was exacerbated before the pandemic. And now the pandemic has pushed that wealth gap further. So you're just seeing that disconnect being played in real time. Now, the stock market prices in the future, and the unemployment tells the story of the past, right? So there's a disconnect there as well. But that's what's really happening, is this whole thing of the wealth gap is being completely exacerbated. However, those markets are cooling off because they just got into sort of unsustainable territories. When you look at stock markets price in cash flows in the future, and they had to go so far into the future based on the earnings numbers to justify where the stock market was trading. Somebody woke up and said, whoa, that's pretty far into the future that we're pricing it in. And it's assuming a lot about the pandemic. And so naturally, also, when stock markets go up on very, very steep angles, it's not natural for something to accelerate on a steep angle for that long. So it's going to have a reversion to the mean, we call it, or it's going to pull back some to get back on a more sustainable path if growth is going to continue.
Really, really quickly, and I hopefully I'll get into this particular topic more with you. I saw a study recently that talked about, in a way, the psychological scars of the coronavirus, right, for businesses, that even once we get over this pandemic, business has now learned that something similar could shut us all down again, and they will move accordingly in the future. They will change the way business is conducted in the future to prepare for the next pandemic or the next whatever it is. Do you see the effects of this pandemic lasting decades into the future, having an impact on the economy decades into the future?
Certainly I do. And I can just give you my personal story. My work has been busier than ever. My husband is an engineer in auto racing, and all of the races at the beginning of the year were canceled. The races are being rolled out in a limited fashion for the rest of the year. And he just looked at me and he said, I want to be able to make income from home with zero overhead going forward in case this happens again. So, my husband started day trading the market. He loves it. It's similar to the racing mentality. So anyway, that's just my own personal story anecdotally. But I think that psychological premise is pervasive in the sense that people want to be able to work from home, because I don't think this is the last virus we're ever going to see. People want to have less overhead because the businesses that are failing and filing bankruptcy right now have a lot of overhead, and they're not at capacity with, whatever their sales or whatever their product is. And then the other thing that I think is quite interesting is that, inventories might be a little bit lower. People might do more sort of on the fly. People are just going to be prepared for this. I'm sure there will be insurance products that roll out to deal with this. And I just think that people are going to be more aware of sanitization, if someone's sick at work, what to do with their kids. I just think people now have this new reality that's possible in their minds. And so it's going to affect how they live their lives for a very, very long time.
Yep, we call it the new norm, Frances. Stacy, thank you so much.
Thanks, Anne Marie. Happy Friday.